Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and we're glad you're joining us today. We've got an exciting show lined up for you, with a focus on the latest developments in the AI sector. Artificial intelligence is transforming industries and creating new opportunities for investors, but it's also raising important questions about risk and reward. One of the biggest stories in AI right now is the partnership between Nvidia and OpenAI. Nvidia has announced a $100 billion equity investment in OpenAI, which will fund up to 10 gigawatts of AI data center capacity. This deal is being seen as a major win for Nvidia's GPU leadership, and it's got analysts talking. According to Mizuho analyst Vijay Rakesh, this investment reinforces Nvidia's dominance in the GPU and networking space, particularly when it comes to large language models and AI training. The deal also secures demand outlook for 2026 and 2027, with OpenAI set to receive the initial $10 billion in the next few months. But what does this mean for investors? Is Nvidia a buy, or are there other players in the AI space that you should be keeping an eye on? We'll be exploring these questions and more throughout the show. We'll also be taking a closer look at the competitive landscape in AI, including the role of other major players like Intel and D-Wave. And we'll examine the potential risks and challenges associated with investing in this rapidly evolving sector. So, whether you're a seasoned investor or just starting to explore the world of stocks and finance, you won't want to miss this episode of the Riskwiser Zone. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and investment, where savvy decisions can make all the difference. Today, we're exploring two compelling stories that highlight the intricacies of the market. First, let's take a look at an article from The Motley Fool, which discusses the smartest dividend stocks to buy with $10,000. The piece highlights four companies. Brookfield Infrastructure isn't among them, but rather IBM, Realty Income, and two other stalwarts that offer substantial dividends. By investing in these stocks, you can potentially earn a significant return through dividend payments alone. For instance, if you were to invest $10,000 across these four companies, you could expect to receive around $34 in dividend payments over the course of a year, not accounting for any potential capital gains. On the other hand, we have an article from Seeking Alpha that catches our attention, discussing Brookfield Infrastructure's baby bonds. These bonds have taken a hit, trading at 68 cents on the dollar, which translates to a 7.3% yield. This presents an intriguing opportunity for investors seeking both capital growth and a healthy income stream. However, it's essential to consider the risks associated with these bonds, particularly in the face of stubbornly high treasury yields. As we weigh these investment opportunities, it's crucial to remember that every decision comes with its own set of risks and potential rewards. Whether you're considering dividend stocks or baby bonds, a thorough understanding of the market and a well-thought-out strategy are key to making informed decisions. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're wrapping up today's show with a closer look at some interesting stories from the world of investing. First off, we have an update on the Dividend Aristocrats, a group of S&P 500 companies that have increased their dividend payouts for 25 consecutive years or more. According to recent reports, August was a strong month for these dividend-paying stocks, with the ProShares S&P 500 Dividend Aristocrats ETF, Noble, gaining over 3%. This is great news for income investors who rely on these steady performers for consistent returns. However, not all dividend stocks are created equal. We also came across an analysis of PPL Corporation, a utility company that has undergone significant transformation in recent years. While the company's dividend appears to be safe, and it expects 6-8% annual EPS growth through 2028, its long-term performance has been lackluster. As such, investors may want to wait for a better entry point before adding PPL to their portfolios. On a related note, we also took a look at some top picks from the Dividend Aristocrats group, including Fastenal Company, IBM, and Cardinal Health. These companies have demonstrated a commitment to dividend growth and may be worth considering for investors looking to add some stability to their portfolios. As always, it's essential to do your own research and consider multiple perspectives before making any investment decisions. It's also crucial to maintain a balanced portfolio and not put all your eggs in one basket. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.